So we'll do some introductions while we're just waiting another minute for people to trickle in. We've got, my name's Lou Donnelly-Davey, familiar face around here, CMO at Relab. And today we're joined by my co-host Jake, who's also from Relab, a sales exec at Relab. And obviously we've got Ashley Church again, which is really cool. We had a really great session with Ashley last time, and we're super grateful to have him back with us again today, talking all things property outlook and economics, I guess, as well. We're banging on 11, so let's get started. Ashley is a bit more of an introduction. Ashley's an economic and social commentator. You would have heard him speak on many social and economic issues. He's got a wealth of knowledge in the property industry, as many of you already are aware. Of note, he transformed the Property Institute of New Zealand, or PINZ, into one of the country's highest profile member advocacy and education organisations. So super grateful to have you on board with us today, Ashley. Ashley, is there anything else you want to add to that before we dive into questions?
No, let's dive into the questions.
Super. All right, let's get started. So we'll dive into some questions. Me and Jake have both got a few questions, but we'll just let the conversation flow, obviously, wherever it sort of wants to go. So obviously, we've had a bit of an economic upheaval since around 2020. Predictions for the housing market for this year, obviously, and how are they different from your previous predictions, maybe when we last talked?
Yeah, so I'm just trying to remember when we last talked, but I'm assuming it was a little while back. So the difference will be with regard to what happened to the market in December of 2021 and January of 2022, at which stage the market was still humming along, house prices were going up. All of the headlines were about the rising house prices and what a terrible thing they were, and how somebody needed to step in and fix it. And two quite significant things changed that. One of those was the introduction of the CCCFA, changes to the CCCFA Act, which was the Credit Finance Act, in December of 2021, which had a chilling impact on the market. It essentially meant that it introduced a whole range of new rules for banks and lending institutions, the impact of which was that banks were terrified of breaching the new legislation, because the impact of an infringement of those rules in any single occasion could be up to $200,000. So it basically killed lending for first home buyers for quite some period of time. So that was the first hit to the market. The second one was just 2 or 3 months later, with the news that not just New Zealand, but the entire Western world was suffering from a massive increase in the rate of inflation after 30 years of a pretty non-inflationary environment. So to answer your question, prior to that happening, my predictions about the market were all pretty positive. Auckland, which had been in a 2 or 3 year hiatus, which was normal in any 10-year period, was starting to come out of that, and the predictions were that it would start, the Auckland market would start to take off again, and that a couple of years after that, the rest of the country would as well. And that was more or less consistent with the cyclic trend which has carried on for the last 40 odd years. After those two changes, the market changed completely. And instead of the predictable cycle impacting the market in the normal way, the impact of the things that were done quite quickly in order to address those two things were so significant that they, if sort of use the analogy of the earth was sort of knocked off its normal wobble. And we've been in that situation for the last year or so. So at the moment, we're still in this high inflation environment. We've got a Reserve Bank which is absolutely determined to bring inflation under control. And the impact of that is that it will be some time before we see the market restored to some degree of normality, where we can expect house prices to do what they would normally do. Long answer to your question.
Yeah, brilliant. Thanks. Thanks, Ashley. I think Jake's got a couple of things that we'll segue into.
Yeah. No, thank you, Ashley. So, look, you mentioned inflation. It's been a big, obviously, hot topic and pretty hard for a lot of governments around the world since COVID. What sort of tools does the government and the Reserve Bank have that they can implement to control and sort of reduce inflation to get it within their reasonable bounds?
Yeah, so important to understand that in a normal environment, those are two quite separate agencies. So the Reserve Bank is theoretically independent. It's been independent since 1989, the 1989 Reserve Bank Act, which basically said that the the Reserve Bank operated separately from the government in regard to what it did, and it had a pretty clear remit for most of its history around keeping inflation between 1% and 3%. Now, the tools that the Reserve Bank's got are reasonably strong. It's got tools such as the ability to impact the way in which the various trading banks operate their financial policy. But the key tool that it works under is this thing called the OCR, the official cash rate. And the official cash rate is essentially a guide to the trading banks, which indicates to them where it wants interest rates to go, mortgage interest rates to go. And the reason that it uses mortgage interest rates as a mechanism for controlling inflation is because the theory, and in fact the practice, has been that if you increase mortgage interest rates, they are such a significant draw on household spending that the more you spend on mortgage interest rates, the less you're likely to spend elsewhere. That's a very simple way of describing it. And the impact of that is that if you can increase spending in that area and decrease spending in other areas, then inflation comes down. So the Reserve Bank has at its fingertips the OCR. It's been using that quite aggressively, and I think we're going to talk a bit more about that a bit later on. The government has less of a role in this because the government is not the primary agency which is there to control inflation. But it does have one very important tool that it can use, and that is it can spend less. So we've got a government at the moment which is spending $1 billion a week more than the government was spending in 2017, $1 billion a week, which is an extraordinary sum of money. Now, some of that's justified through normal increases in cost, but most of that is just excessive and profligate. So one of the ways in which the government could contribute to getting inflation under control is it could spend less. It could get its spending under control. And I know when I say that there are people who, talk about right-wingers and reducing spending, but in fact, if you look at the spending of particularly this current government, an enormous amount of it is wasteful. An enormous amount of that spending is not necessary and could be carved from the economy without any real impact on services and the things that the government actually does for citizens. So in my view, one of the major things that the government could do, and it could do it very quickly, is to look at shaving its spending down to a level where it was contributing to getting inflation under control.
Awesome. Okay. And with that spending, is it what particular areas do you see are wasteful, specifically in relation to, let's say, the last 6 months?
I don't know if I would necessarily confine it to the last 6 months. I'd probably look at the last 5 years, to be honest. And I would look at things like the spending on consultants. So this government came in indicating that it was going to, they used a term that Helen Clark used back in her term, which was what they talk about capacity building, which I would basically say is just a flash term for public service bloat. And the idea is that you employ a lot more public servants in order to provide the services that supposedly the public requires, or the policy direction that the public requires. So there's been an enormous increase in that. Now, one of the promises that was made by the incoming government is that in order to fund that, it would reduce what was being spent on consultants. It hasn't done that. So we've had both an increase in public service numbers and a pretty significant increase in the cost of consultants, and that's added a very, very large number to the wage bill for the public service. But there's a whole range of other things. There's an enormous tendency to use consultants and consult on things rather than getting anything done. So if you look at infrastructure, for example, lots of promises, lots of talk about various different infrastructure. A good example of that being light rail to the airport in Auckland, but very little work actually being done. So a lot of money being spent on things. So either do them. Either get those things underway and spend money on the infrastructure that the country requires, or don't do them and don't spend the money on the consultants. But there's a whole range of other ideological things which we could probably argue about whether they're actually good or bad for the country. There was an enormous amount of money invested into mental health, which, as far as it is apparent, doesn't seem to have made any difference at all to public health, to mental health numbers. There's an enormous amount been spent on consultancy around reducing child poverty, which has actually gone up during the term of this government. I mean, the list goes on, and the point of this for me isn't necessarily to slag the government, except to say that the spending's not wise, and that if it's not wise, it could be cut in a way which would help us to get that inflation number under control.
Yeah, no, thank you. Thank you for your insight. And I guess before I pass back to Lou, one final question here. We'll swing it back to property. What is the likelihood, you think, of the OCR coming down before the end of the year?
Low. low, and I'll tell you why I say that. There are several outcomes that could happen over the next few months. So every quarter, the Reserve Bank looks at the inflation rate, and it's looking to see whether that rate's gone up, stayed the same, or come down. And over the last couple of quarters, that rate's been stubbornly the same at about 7.2%. Now, that's good news in the sense that it means that it hasn't gone up any further. It's bad news in the sense that there are other economies around the world where that rate of inflation is dropping. And there's a range of reasons why it hasn't dropped here, one of which, in my opinion, would be that amount of prolific spending that the government's engaging in. But the reason I say that it's unlikely to come down is, so let's take those three scenarios. Let's say it had gone up. If it had gone up, you would absolutely expect that the Reserve Bank would raise the OCR further. There's no question of that. Because they are obsessed with, probably quite rightly, getting inflation under control. If it had stayed the same, and it has, then you would probably still expect the OCR to go up. And the reason for that is because it's 7.2%, even though it's not a further increase, it hasn't come down. And what the Reserve Bank's looking for is an indication for of the inflation rate dropping, not just staying where it is. And there's another factor in that incident which is important, and that is that the Reserve Bank actually never knows at any particular point in time whether it's done enough. So it's quite possible that the last OCR increase that was kicked in, and indeed the one before that, actually did enough to get inflation down. The problem is that because a lot of that's measured in terms of people spending, and that spending isn't necessarily impacted until their fixed rates change, it can be some months before the rates on mortgages change, which means the impact of that can take quite some period of time. The third scenario is that inflation comes down, and let's say in the next quarter that inflation actually drops and it's below that 7.2% level. That still doesn't necessarily mean that the Reserve Bank would drop the OCR. Best case scenario there is that they would leave it at the same level, and it is still possible that they would still increase it. Their argument being that even though it's come down, it hasn't come down far enough or fast enough. So for those reasons, I think that even in a benign environment where inflation looks to be dropping, I still think we're going to see a pretty rigorous approach by the Reserve Bank, because their focus isn't on 7.2 or 7 or 5. It's in getting it under that 3% mark. It could be a while. I do make the point, though, and this is really important, in order to restore confidence to the housing market, interest rates actually don't need to drop. And that's a strange thing to say. All that needs to happen in order to restore some confidence to the market is people have to have confidence that they're not going to keep going up. So at the moment, the reason that we're taking such a hit to the market is because people are worried that if they buy a house, that their rates could further increase. Provided they know that's stopped, provided there's a clear stare from the Reserve Bank that indicates that those increases will stop, that will be enough, in my opinion, to restore some hesitant confidence to the market, which will A, stop house prices reducing, and B, potentially actually cause them to start increasing at some stage over the next little while. But we're not going to see a huge increase in house prices until, as you say, interest rates do come down, and I think that's a little way away yet.
Yeah, super interesting. You know, as an economist, you're 50% of the time, you're right. I personally don't think the OCR is going to move again this year, up or down. But given, and that's a really interesting point that you make around, it doesn't have to, interest rates don't have to come down, or the OCR doesn't have, or inflation doesn't have to change in order for people to start to build their confidence again. Given where interest rates are now and fluctuating house prices, depending on where you are, of course, because down here in the south, things haven't fluctuated quite as much. Do you have any advice for people wanting to get into the property market, or in fact, exit some of their investments or whatever? What would you say to people right now?
Oh, look, the answer to that question really depends on the what people are trying to achieve in their medium to long-term trajectory. By which I mean is, if you're looking to buy a house for the medium to long term, either a first home, or looking to replace an existing home, then, and this will surprise people, but then to some degree, house prices actually don't matter. And there's two reasons for that. One of them is that if you're selling a home to buy another one, you're buying and selling in the same market. So the net effect of that's actually not going to be particularly relevant to you. But more importantly, house prices in the medium term will continue to rise. There's no question of that. So this funk that we're in at the moment won't last. We don't know how long it will continue, but it won't last forever. And when we come out of it, house prices will return to their 40-year long-run trajectory. And the long-run trajectory is to continue to increase. We could debate the speed at which that increase will take. And if we've got time, I'm happy to give some views on that. But they will increase at some rate. So if you're looking to buy right now, I wouldn't be too concerned or too obsessed with what's actually happening with prices. And even more so because if you look at the rate of decrease in the areas where those decreases are still taking place, there's quite a perceptible slowdown in the rate of decrease, to the point now where we're talking quite small decreases in any quarter. So I wouldn't be particularly worried about that if I were looking at the long term. The flip side of that is, if I was a trader or a flipper, certainly wouldn't be buying right now because the normal trajectory for a flipper is that you want house prices to go up, and whether you're adding value or simply waiting for the market to do that. We're not in an environment where that's going to happen. So medium to long term buyer, either first home buyer or somebody looking to sell a house and buy another one, I would largely ignore what's going on and simply do whatever's right for you for your life right now.
Yeah, interesting. I mean, do you want to elaborate a little bit more about that long-term trajectory?
Only that. So if you look at the market over the last 40 years, 50 if you go back to 1970, 40 if you go back to 1980, and I differentiate between those two because there was a pretty significant event that happened in the 70s. But if you look at the market over the last 40 years, the trajectory of the market's been consistently up for a long period of time. And for quite a period of time, I and other commentators had this mantra where we were talking about the fact that the market doubles every 10 years. And if you talk to anybody who's been involved in property or property investment for a long period of time, they'll quote that mantra to you. But what was interesting about it was that there wasn't any empirical data. It was more sort of a market observation that people used to make. And about a year ago, I decided that maybe it would actually be a good idea to actually get some data on it. So I went to Velocity, who are one of the two property data companies in New Zealand, and asked them if they could provide me with data indicating what had happened to house prices over the last 40 odd years. And they said to me, well, we need to know a date because we have to be able to pick a date each year. So I said, make it the 31st of December. So they gave me the data for the 31st of December for the median house price across New Zealand for every year since 1980. And what I did was, and it's a shame I don't have the data to show you on stream, but I'll see if I can describe this to you. When I looked at those sets of data and I compared, it's quite hard to describe this, but I compared not just each decade, but each of the decades within the decades, by which I mean is if you look at 1982 to 1992, that's a decade. If you look at 1983 to 1993, that's another decade, if that makes sense. So I looked at each of those, and each of those increases was different for each of those 10-year periods. But when I averaged it out in any 10-year period, between 1980 and 1990, it was almost exactly 100%. Between 1990 and 2000, it was about 101%. And between 2000 and 2011, it was about 99%. So in each of those decades, it actually was almost exactly 100%, which I have to say, as much as I've been quoting that mantra for a long time, I actually found stunning because it showed that figure was exactly right. Here's where it gets interesting, though. When I looked at that figure between 2011 and 2021, the rate had actually dropped. And in that 10-year period that I just quoted, it had only grown by 73%. And long story short, I looked to see how long it took to double, and it basically turned out that over that period, you had to go, if you went backward from 2021 back to 2009, it actually took 12 years for house prices to double rather than the traditional 10. So those first 3 decades, almost exactly doubling. That last decade, longer actually, it actually took 12 years to double. Now, what I surmised from that was a couple of things, because over the last 30 or 40 odd years, certainly the last 20 years, people have been talking about house prices getting out of control in relation to household salaries, and that wasn't sustainable. And that tends to suggest that's correct, that it isn't sustainable. And as much as house prices had continued to go up, it was getting more and more difficult for those prices to increase in a market where they were getting further and further out of whack with incomes. And the other one was, and this was quite interesting, was that the thing that's fueled that house price growth over that 40-year period has been the cost of money. So, and that's indisputable now. If you look at the cost of money and you relate it to house price increases, while the cost of money has come down, the house prices have gone up. So there's a very, very clear causal link between the two. What had happened by 2021 is the cost of money was getting so low that the impact that it was having on actually driving up house prices up further, or its potential to do that, was arguably reducing. So what does that mean for the market going forward? It means that house prices will continue to double, but they won't double in 10 years. They might take 12, or they might even take 15 in any period. And that's an important observation for two reasons. One, because it means that the trend's still there, but it's slower. But secondly, it means that you can still have confidence in it. It's just not going to happen as fast as it did. Now, what that might mean in 40 or 50 years, when I'll be dead and you guys will be very old, is that house prices we might get to 2050 and house prices might go up 10 or 15% in a decade. So that slowing will continue. It's just going to take us a long period of time before we get to that point. So I'm very confident it will continue for some period of time, but it won't be at the rate that it's been over the last 30 years.
Awesome. Thank you. Thanks, Ashley. And so I guess we've talked quite a bit now about the house prices, and from the buyer side. What about in terms of rental prices? What's your sort of observations for short-term rental prices and long-term rental prices? And this also ties in quite well with what Craig's just asked in the chat. So thank you, Craig.
Yeah, I'm quite worried about rental prices for a couple of reasons. The first reason is because of the bloody-minded intransigence of this government in respect of its determination to punish the rental sector, punish landlords. And it's done that with punch after punch after punch over the last 3 or 4 years in respect of the things that it's done to try and make it more difficult to invest in property, which is extraordinarily stupid, given that private property investment or private rental investment is by far and away something like 90% of all rentals in New Zealand are provided by the rental sector, by the private rental sector. So it's an extraordinarily naive, juvenile and stupid thing for a government to have done, and it's definitely had an impact. And amongst those, the strongest impact has probably been twofold, actually. One of them's been the reduction or the removal of the ability to claim interest deductibility on rental investment. And the other one's been something called the ring fencing of tax losses, which I'll come back to because it's arguably the most important of all of the things that the government's done. Anyway, the impact of that is that property investors as purchasers of rental property largely disappeared in February of 2021, not December 2021 when the market tanked, but February in 2021, 9 months earlier, 10 months earlier. And the impact of that has been that the rental stock in this country has been reducing as a percentage of the population, because the population continues to grow. Now, the reason that'll have an impact on what it costs to rent is twofold. One, because it means the number of properties are reducing anyway. And two, we're about to see either this government or the next one, a massive increase in immigration. Which is absolutely necessary to deal with some of the infrastructural issues that we've got. And we've essentially closed that door, partly because of COVID, which was nobody's fault, but then continued to close it at a time when we should have been opening it again, when we've got enormous labour shortages. And so we're going to turn that around. And over, I think, a 2-year period, either starting this year or certainly starting toward the end of this year, you're going to see huge increases in numbers of people coming into New Zealand, all needing somewhere to live. Now, some of them will buy and some of them will need to rent. That's going to put a phenomenal increase or phenomenal pressure on the rental sector, which inevitably will drive up the cost of renting even more than it's gone up over the last 2 or 3 years. So that's a pretty scary story for the country.
Yeah. No, absolutely. Okay, so sort of in your words, then you're thinking we're looking at a possible rental shortage in the sort of short to medium term? I'd
go further. I don't use emotive words easily, but I think we're looking at a rental crisis within 3 years in terms of shock. Yes, a shortage, but not just a shortage, a crisis in respect of the lack of rental supply versus the requirement for it.
Hey, I'll just jump in here. I know you've got one more question to ask, Jake. So what do you think, if we do have a change of government in October, how do you think that's going to change housing market, but also the rental market?
So the housing market, it won't make a lot of difference. And the reason for that is there's actually not much that governments can do in respect of house prices. And the evidence of that, you look back over the last 40 years, governments have talked about what they're going to do about house prices and haven't made a jot of difference with all the various different measures that they've taken. And it's interesting because people will say, well, what about the last 12 months in respect of what's happened to the market? Well, again, that wasn't the result of government policies. Or actually, let me be fair, it was the result of government policies, but they weren't government policies that had anything to do with the housing market. One of them was the changes to the CCCFA, which did have an impact on the market. And so you could argue, well, you could stop house prices going up by simply making it impossible for people to borrow money, because that was effectively what happened. But no sane government would do that. And the other one was inflation, which was primarily an international phenomenon, which again had nothing to do with housing policy. So none of the steps that have been taken by this government, or indeed the previous one, or the previous ones to that, going back to the 80s, have made any difference to the trajectory of house prices whatsoever. And this one won't either. The incoming one won't either. With respect to the second part of your question, which was about rentals, one of the things I would expect if we get a National Act Alliance government is that we'll see a couple of quite significant changes to the rules that affect property investors. And so they've already indicated that they will reduce the bright line test back to the original 2 years, which will make some difference. It won't be a huge difference, but it will make some difference. The other thing they'll do that will make an enormous difference is that they've indicated that they will restore interest deductibility to the rental sector, so that landlords will once again be able to claim interest as a deductible expense. And that will make a much more significant difference, because it will make it more attractive to get back into the rental market. However, and this is a big however, and this is something that it needs to be shouted to from the rooftops by property associations and other people around the country. National have not made any noise whatsoever about the ring fencing of tax losses. Now, that's a boring subject, but it's a really important one. Let me explain it for those of you viewers who don't know what it is. The ring fencing of tax losses is something that came in about 2 or 3 years ago as changes to an omnibus of rules that related to taxation. And basically what it means is that whereas with any other form of business, including property investment up until these rules were changed, if I own a business and I've got a salary, if I own a property investment and I've got a salary, or indeed if I own a business and I've got a salary, if I make a loss on the business, I could transfer that loss to my salary and reduce my taxable income. Absolutely legitimate, absolutely normal. That's been available to anybody who's operated any form of business, including owning property for 100 years. It's just how tax law works. Labor changed the rules and said that going forward, that wasn't going to be possible. And if you made a loss on an investment property, that loss could only be applied to the investment property itself. Now, that may not sound like a big deal, but if you're a relatively new property investor, by which I mean if you've owned your property for less than anything up to 10 years, and particularly if you're in Auckland, you're going to make a loss on that property for a long period of time. So what that means is if you can't transfer that to your other income, then it simply builds up and gets bigger and bigger and bigger until eventually that property actually gets to a point where it's profitable, and then you can start to use it. Now, why that's important is because it means for most newer property investors, even though they'll be able to claim things like interest deductibility, it will be useless to them for a very, very long period of time. Now, I've put that question to National and said, this is insidious and you need to get rid of it. What are you going to do about it? And I've got crickets, basically. They've completely ignored the question several times, and I believe that's deliberate. The reason it's deliberate is because if they reintroduce, if they get rid of ring fencing of tax losses, then that will have an impact on their tax income and their tax base. And it could be quite a significant thing. It could be a couple of $100 million per year. But I would argue that that's, so what? It's fair. That's the way all tax is treated for any other form of business. So if that doesn't happen, then even with the reintroduction of tax deductibility and the reduction of the bright line test back to 2 years, it actually won't make an enormous amount of difference to the economic viability of rental property, which means that people will still be put off purchasing rental units, and it will still impact on the rental market overall.
Awesome. Thanks, Ashley.
Boring answer, but important.
Cool. So I think we're going to jump sort of to the other side of the fence now and take a look at, and if you can explain, the notion that the housing shortage was a myth. And from that, what are the consequences of having a saturated housing market?
Yeah, so first, to answer the first part of your question, in 2012, Labor under David Shearer and Annette King announced at one of their conferences that we had a housing shortage, and they claimed that we had we were short 100,000 homes, and we needed to build them very quickly to make that shortage up. And they leapt forward from that. It became a mantra. National bought into it within 2 or 3 years. And quoted it as well. And over a period of time, people, including me, to be fair, I was saying the same thing at the time, were putting the boot into the government, which was National at the time, and subsequently Labor, saying you need to be building these houses as quickly as possible because we've got a shortage. Now, I, to my shame, didn't actually analyse those figures until about 3 or 4 years ago. And when I did, I found to my horror that there's actually no basis whatsoever to the claim that we have a shortage of houses. Now, I did that with 2 very easy figures that are anybody can get and check what I'm about to say for themselves. One of those numbers is the population of the country, and that just makes sense. If you look at the population of the country, that's a guide as to how many houses we require. But the other one is in the census. There's a figure called average household occupancy, which is a measure of how many people on census night live in their home on average. And that figure in 1986 was 3.29 people per household. And by 2013, it had dropped to 2.83. Why is that significant? Because it could only have dropped if we had actually built more houses. There's simply, the math doesn't lie. There's no other way to work that out. Now, let me give you an example of how important that number is. What that tells us is that on census night in 1985, and I won't bore you with the population numbers, but basically we had about 985,000 houses in New Zealand. Now, as you would expect, between 1986, and 2013, the population had grown. But if you took that figure that I just mentioned into account, the 2.86, and you divided it by the population at that stage, what it told you is that our housing supply had actually increased to 1.5 million homes over that 27-odd year period. Why that's important is because that was 200,000 homes more than we would have required just to stand still. And that's why that average household occupancy number had dropped. If it had stayed at 3.29, that would have told us that even though the population had increased, we had built just enough houses to meet that demand. In fact, we'd actually built 200,000 more than we required. And that was a shocking revelation for me because it was completely at odds with what we'd been told, what the country had been told for the last several years. Now, what was interesting about that was I then did some investigation to find out where that number had come from, where Labor had got that 100,000 figure. And it might surprise you to find this, but there's actually no empirical data to back that up. There was no report, there was no investigation, there was no independent advisory of any kind. I finally found where that figure came from, and I kid you not, the figure of 100,000 came from Labor's 1981 election manifesto. So they had literally dusted off a 1981 policy and put it back out there because they thought it would be popular with the electorate. So there is no housing shortage. There never has been, and that number was literally made up. So the second part of your question was how might that impact on the market in terms of oversupply? Look, I actually think that's fixing itself at the moment. Not by design. It's just a coincidence that it happens to have happened at the same time that we've had this slump in housing. So the impact of that has been that a lot of stock that was going to be built isn't being built. And the effect of that will be that what might have been a massive oversupply, I think, will be a much smaller oversupply over the next 2 or 3 years. And I would expect the market to mop most of that up over the next 2 or 3 years, by which I mean that as the population continues to increase and construction tapers away for a period of time, most of that will be used and will dissipate, and that number won't be nearly as bad as it might have been had we seen a lot of this construction continue the way it was envisaged before the market took the turn that it did last year.
Super interesting. We are running at about 35 minutes so far. So
Sure.
I've just got one more question for you, and then we'll jump over and have a look if there's any questions that we haven't already answered. There might be one maybe there that we haven't touched on. Apart from inflation and Reserve Bank and any government policies, are there any other factors that you want to mention that might influence the housing market this year?
Yeah, no, that's a really good question, and the answer is no. But putting aside what's happening at the moment, I often present on what's influenced house prices over the last 30-odd years. And I talk about the things that people believe have influenced the market. So they talk about foreign buyers, and they talk about property investors, and they talk about immigration and some of these other things that are favourites of people to blame, and talk about government policy being needed to fix these things. What's interesting is that when you actually analyse it and look at it, none of those things have actually been a big influence of house prices over the last 30-odd years. The primary driver, as I mentioned before, has been the cost of money. So when you look at the argument for that now, it's almost so strong as to be irrefutable, is that the reducing cost of money from 21%, 22% interest rates in the mid 80s down to getting as low as sort of 2.5, 2.6 before what's happened over the last year or so, has been the big driver of house price drops. So in terms of what's likely to impact the market going forward, it will continue to be those things. And inflation jumps will come along from time to time. We had another one of these in 2004 where the Reserve Bank had to put interest rates up in order to get inflation under control, which it did. So this will happen again from time to time, but that trajectory overall is going to be downward. Now, what's interesting about that, and I certainly wouldn't have anticipated this a year ago, but it's a real thing now, is I was actually saying toward the end of 2021 that because rates were getting so low that there was actually not much gas left in the tank when it came to pushing prices up further, because money was getting so cheap that the leverage value that lower interest rates had and pushing house prices up was largely gone. And then along came last year, where interest rates went up to levels of 5, 6. Who knows where they'll end before this thing finishes. The downside of that obviously has been the impact that it's had on the market overall. The upside will be, if you see it as an upside, that when the Reserve Bank starts to reduce mortgage interest rates again, which it will, that will have a whole nother round of impact on house prices and will push them up again for the same reason that it's done so over the last 30 or 40 years. The reducing cost of money is the major driver of increasing house prices.
Yeah, and I'll just jump to this question. So the recession question. Do you reckon there will be a recession, or is that ship sailed? If we were going to be in a recession, we would be there by now.
Yeah, I mean, there'd be a lot of people for whom that question's moot because they're looking at their household food prices and some of the costs that they're experiencing at the moment, and they'd say, well, we're already in an environment that's not particularly pleasant. But in terms of the technical definition, and I think we actually did meet the technical definition in the last quarter, and if we didn't, we probably will. So the technical definition from memory is and I can't remember what the exact percentage is, but it's a lower period of growth for a certain period of time. And we'll probably meet that technical definition. But in terms of what people mean when they talk about a recession, I think you're right. I think that ship's probably sailed. And that's probably being buoyed a bit by the fact that we've got this unusual environment where prices are going up, but we've still got strong employment and some of the other indicators that you would expect to be down in a period in a recessionary period are actually holding up at quite strong levels. So I think in terms of the real meaning of that term, we're probably okay. Having said that, the Reserve Bank deliberately used that term when they did because they're trying to scare the market because they want to get spending down because they want to get inflation under control. So you may still continue to see some rhetoric from the Reserve Bank around that. And I think they'll be unapologetic in that approach. And as I said before, as much as I criticize the Reserve Bank for a lot of things that they do, I think in this regard, they're probably right because the consequence of not getting inflation under control is way worse on an economy in the medium to long term than anything that might happen as a result of house prices going back a little bit.
Yeah, awesome. Thanks, Ashley. And I do see there's a couple questions in the chat, and we do have a few more minutes, so I'll try and get through as many of these as we can. And if you do have any other questions, audience, please throw them in the chat and we'll address them after, even if we don't get to them right now. There's a question here about properties that are in flood-prone and floodplain areas. How do you think their prices are going to be affected? And what do you think the council sort of policies are going to be now after the recent weather we've had? Well,
I'm in an interesting position in that regard because I'm sitting here in my house in the Esk Valley, which for anybody who's familiar with what's going on around the country will know that was the worst part of the country. So I'm literally on the fringes. I'm on a place called Whirinaki, which is a beach, and the Esk Valley is literally right there. So in places like this, and I'll use this as a sort of a metaphor for other places that have been hit by Cyclone Gabriel, if the homes were untouched, such as Whirinaki Road, where I am, but it won't have any particularly strong impact on house prices at all, I wouldn't think. In the areas further into the valley here, or in Gisborne, or in Pakawhai, which is on the other side of between Napier and Hastings, or anywhere else that was hit, where there's been significant damage, it'll have two impacts. One of them is that it will impact on, obviously, the price, even where houses weren't necessarily impacted immediately, it will have an impact on the value of those properties because people will be worried that it might happen again with some cause. Because, and we forget this, and this is why I rubbish the claims that this is to do with climate change. It happened in 1998. It happened in 1963. It happened in 1938. And in fact, the worst incident was in 1938, even worse than what we've had now. So this isn't climate change. This is a cyclic thing that's been happening in this part of the country for at least 100 years and probably longer. In fact, I think I also heard a figure of 1897 the other day. So this is something that continues to happen, and people will be concerned that every 35 to 50 years, houses are going to be destroyed. They're not going to be so keen on buying them. But the other thing that will impact on them quite strongly is that insurance companies just won't insure them. So the Esk Valley is a really good example. It's going to be impossible to rebuild there because no insurance company is going to be prepared to insure in an area where every 35 to 40 years, houses are destroyed or severely damaged. I think looking forward, there's this a term that's coming back into vogue. It's been around for a long time and it relates to climate change, but this term of managed retreat. And it's this idea that we recognise that there's nothing we can do about changing what's happening to these areas where there's significant erosion or where there's been climate disasters. And therefore, we just need to make sure that people don't build in those places anymore. I think you'll see that become much more vogue. You'll start to see it appearing in documents much more, and we're likely to see that impacting. And where councils and governments literally say, hey, we can't do anything about this, so we're just going to basically encourage people to get out of those areas and never go back there.
Great, thanks, Ashley, and thank you for that question, audience member, because I did sort of summarise it into one little piece. So I hope that covered off most of it. And then final question. I think we'll finish on here, throwing it back to the recession note. Do you think it's going to be best for the New Zealand economy that we enter into a period or recessionary period in a controlled recession environment, which will help ease inflation, rather than being forced in at a jump?
I think that presupposes a lot of things. It presupposes that a recession is the only way of getting inflation under control, and I don't necessarily accept that. I think probably the better question is it better that we control the retreat from spending to get inflation under control, which may or may not lead to a recession? And my answer to that question, which I've just posed, is yes, it is. So it's important that the Reserve Bank does what it needs to do. But if we can do that in a way that avoids recession and gets the country back into that 1% to 3% range, which we'll get back there. We've done it before and we'll do it again. Then that's the most important thing. And while I don't rate the Reserve Bank and I don't rate the current Reserve Bank governor, and I think they've made some awful mistakes when it comes to particularly the housing market, I do think that what they're currently doing with regard to inflation is probably the right move. To the inflation is probably the right move, and that it will have the impact that it's desired to. So the only issue we've got at the moment is not will we get inflation under control and will interest rates come down. It's simply how long will it take to get inflation under control and how quickly will interest rates come down. Both of those things are certain. It's just a question of time, and nobody knows the answer to that question.
Yeah, absolutely. I think you touched on it before that irrespective of whether, I think somebody in the chat said negative growth for 2 quarters is a recession. So whether right, you slap a label on it or the government announces or the Reserve Bank announces that's where we're at, a lot of people are feeling the pinch, and a lot of people sort of certainly feel like that's where we are right now. Hey, I think we'll wrap that up here. We're on about 45 minutes, so that's a pretty intensive webinar. Thank you once again for joining us. Always a pleasure to have you on, and we shall probably have you back again because our audience loves you, and there's just so much to talk about in respect to these issues. Perhaps we'll get you back after the next election. We'll see how it goes. We'll see who gets in, and we'll have you back for some commentary on that. I think that sounds like an interesting idea. Jake, any final thoughts?
No, look, thanks a lot for your time, Ashley. Always great hearing your insight and some really helpful thoughts. I think the audience are going to take away a lot from today's webinar. So thanks for attending, audience members, and thanks, Ashley, again.
Thanks, guys. Talk again soon. Ta-da.